This is TreppWire with a special episode of the TreppWire Podcast, a global structured finance update. For the week ending August 12th, I'm Andrew Jacobs with Trepp, a data modeling and analytics firm for the CMBS commercial real estate and CLO markets. I'm with Vivek Anand-Datani, global head of structured finance, and Andrew McClymondt, structured finance analyst. In recent weeks, what's been happening? Where are the market participants watching? What are they doing? What's going on?
So we'll start with looking at what's going on globally and then narrow it down to Europe and the UK. So the IMF chief economist has warned that the world may soon be teetering on the edge of a global recession, 2 years after the last one. The slowing growth and rising inflation rates, as well as the aftershocks of COVID-19 and the war in Ukraine, continues to impact the global economy. And what we're seeing is that demand is to be suppressed by the aggressive action by the world's biggest central banks to increase the cost of borrowing, to tame inflation, coupled with the conflict in Ukraine and a slowdown in China because of COVID restrictions that's ultimately going to slow the recovery. For example, in the UK, the Times reported that inflation could reach 15% early next year. Due to the price of wholesale gas, Bank of England announced the largest interest rate rise in 27 years. £2 billion has been added to the cost of borrowing overnight. The CPI is now forecast at 13.3%, which is the highest rate of inflation since September 1980. We have loyal listeners, and I wanted to share some sentiments that Anne L very kindly sent in. So globally, we're all seeing about the issues within airports and travel, and we'll briefly touch upon it when we review global ABS and SFVegas in due course. But airline staff are needed. Recruiting is now on the way to recruit more staff at airports to minimize disruption. We're also seeing that there's no shortage of tourists. A lot of people are taking that summer vacation. We see many Brits going to their loved countries of Spain and Portugal, which is great. And then finally, in the UK, Brexit's long-term impact continues to hamper life as we know it. And finally, Anne, thank you very much for sending this through. But in the hospitality sector, demand is still strong, but the bottom line is still being hurt by rising staffing costs, even if you can find and retain the staff, as Anne mentioned. Food and other supplies are more costly and harder to procure. Energy costs are soaring, servicing debt may become an issue, and lenders may not be as patient at this time. Increasingly, hotel sales are reported without price disclosure, less transparency, signaling to more potential and actual duress. And I know that Andy's going to touch upon the European CMBS market later, where we'll run through a few examples.
Just going back a little bit to the inflation in the US, there's obviously inflation too, and they're also trying to raise interest rates to address it. People aren't sure that the interest rates are necessarily going to help because, the source of the inflation is at least partially supply chain issues. I mean, is it a similar story in Europe or different?
Yeah, we're seeing a similar story in Europe. There are supply chain issues, rising prices of oil and gas, as we're seeing. Although saying that, I did drive past a petrol station this morning, and the price of unleaded petrol has significantly decreased since the last time I drove past. So I think that inflation is going to continue to be an issue for both the US and the UK and Europe.
There were also a couple conferences recently, pretty major conferences. So there was Global ABS and equivalent in the US, SFVegas. I know you guys attended the Global ABS conference, but what was kind of the word there?
It was great to be back in Barcelona, was the main sentiment. We took a 2.5-year hiatus because of COVID, and everyone was just was just appreciative of being back together in the warm climate that Barcelona has to offer. In terms of the sentiment with the market, there was a very cautious sentiment at that time. So this was the middle of June of this year, and many of the market participants were waiting to see how macro events played out. One thing that I guess the predictions were with the panels that we attended was that the market participants were predicting slow growth. Labor markets are anticipated to be strong. Job vacancies recently grew to 2 times the unemployment in the US, for example. A slowdown in the housing market is likely to occur, though a crash is not expected. There are several downside risks that we heard, including the changing of the geopolitical landscape, climate transition, and second-order effects. Thus, there is a huge variety of potential outcomes. Nevertheless, most sectors are performing better than expected. We're seeing a gradual increase in SME insolvencies, which could be observed due to an increase in indebtedness post-pandemic. The CMBS outlook is mixed, with a potential UK retail rating downgrades, while logistics did remain stable. I would just like to shout out that we have got a blog going into much more detail reviewing global ABS, so please do reach out to podcast@trepp.com if you'd like to receive a copy.
Yeah, I think it was a pretty mixed bag in Vegas. I mean, you were also there in Vegas with us. I mean, heading into Vegas, we had done some CMBS focused conferences and some commercial real estate conferences. And in those specific conferences, people were pretty worried about performance. It seemed like there were a lot of headwinds to pretty much everything in the industry. But when we got to Vegas, which is obviously much broader conference across structured finance, people were, I think it was more balanced. Certainly nobody was, jumping for joy, but it wasn't quite as, it wasn't filled with doom and gloom either. Specifically for CMBS, commercial real estate, not covered a ton at the Vegas conference. They actually focus more on the other asset classes, but on the corporate CLO side, for example, there was sort of like a balanced view, right? There were some headwinds, but overall people felt like that CLOs would pull through and would ultimately be okay.
Absolutely. I mean, CLOs have always been quite a resilient asset class through these particular downturns in the market. So yeah, definitely agree with that. I mean, I did see some people jumping for joy, especially when we opened our ice cream booth on the Monday morning.
Yes, there was also a lot of doom and gloom when they came and there was no ice cream left. So
the ice cream was sold like hotcakes. And we also had, not only did we have ice cream in Las Vegas to combat the desert heat, we had coffee in Barcelona, which was also proved to be a good hit. Yeah, I think just to summarize those two conferences, it was great to get everyone back in the same area. And it was great to talk to our clients, partners, and prospects. And I think people are generally seeing how the market will play out, but hopefully we'll see activity increase towards the end of the year. And I know we're going to be at a number of the upcoming conferences, specifically around CLOs and CMBS. So if you are attending any of the conferences in the UK, Europe, or America, please do reach out to schedule a meeting ahead of that.
So, let's dig in a little bit more detail now. We talked broadly, but let's focus in on just kind of the unsecuritized or broad commercial real estate market. Has anything been going on there that's kind of worth bringing up, Andy?
So I think, as Vivek and you've alluded to, about interest rates rising across the US and EU, everyone's kind of looking at CRE and a marketplace that's normally been used as a hedge against inflation in the past. I think actually a really key kind of investor sentiment or outlook was FinLeap's Q2 2022 credit barometer. And they kind of mentioned how the investors were viewing the market, and they said that debt affordability was a major factor with the reduction in yields and the increase in lending rates. And overall, they're actually seeing in the CRE space, especially in Europe, lending conditions kind of declining. And they've then put a focus on that there was a massive reduction in investors looking at hotels and student lodging for student housing in the UK and Germany. So I think as a sector, it's been pretty interesting to watch. Now, it all kind of sounds a bit doom and gloom from that quick report, but we have seen some really interesting investments in the space of logistics. So I'm going to touch upon this a bit more in CMBS later on, but logistics has been something that we've seen after the pandemic kind of boom back as the global market kind of picked up and the supply chain came back. We kind of saw that everyone needs to actually send stuff around the world, and that's where logistics kind of boomed. Now, there has been some kind of doom and gloom again with that, with the Amazon warehouse facing, with the fact that they kind of oversubscribe to warehousing. But in Europe, we're kind of seeing that there's still not enough warehouse space right now. So there's a lot of investment going into that and a lot of investor sentiment backing it. And what I would like to touch upon is what Vivek mentioned earlier about the hospitality sector. So there has been a lot of tourism coming in, especially into London. And that's great to see right now. But with the fact that there's a recession probably coming on the horizon, what's actually going to happen in the hospitality area? So if inflation is going to go up or the underlying costs are going to rise, will we actually see a major impact with the end of tourism to kind of combat the increased cost? And when people want to travel, so on a fully off note, something that's happened to me, I've been looking at going on a skiing holiday later this year, and already something that used to cost like £700 is now over like 1,000. So it's already kind of making me think, do I want to travel outside of Europe in December? And will we see this for other people? So in sectors that are heavily demanded on business travel or tourism, let's say London, New York, but people are flying in all the time just to visit that one area for business or just like one location. Will we continue seeing people actually coming there, or will we see people kind of going further abroad to different areas that are cheaper? So I think that might then have a little bit of impact on if hotels are impacted again there. Will we see further delinquencies? So in the CMBS space, that was one of the major areas that got impacted from a delinquency point of view.
It was also interesting when the dollar hit the same value as the euro a couple of weeks back to see how that would impact tourists from the US coming to this side of the pond as well. So that would be very interesting to keep an eye on as we progress through the next few weeks and months.
I think a very interesting point, especially how this amount of a one-to-one ratio. I'm going to see as much in Europe actually think about out of the country, out of the continent. And then I think lastly, one of the other sectors that everyone always touches upon is office space. So recent news, Spotify released earlier this week that all their employees can now work anywhere in the world they want. So there's no need to go into the office. And a few other big tech firms have done that. And they've noticed that a lot of employees aren't even within 2 hours of the office now that they can go anywhere they want. And employee kind of sentiment is coming up saying they're more happy now, they're able to get more work done in the hours. They can use like commuting time and have to work out and be a lot healthier. So office space is always largely kind of dominated the CRE landscape. And it's going to be interesting again to see how, with a recession, will people still stay away from the office? If, let's say, any of the tenancies are coming up to the end of the contract, will people actually roll them over again like they did in the past? Like, especially in the pandemic, we saw that if someone didn't have a tenancy coming up, there's no need for them to roll over to the next year or 5 years. And so even though it's done pretty well, looking back on the long-term average, it's that point of view now saying, well, will we still see investment from these big firms, or is it cheaper for them just to say you can work from home? Now, but on the flip side, we have seen from lots of news recently that investors are still coming into the office space if that office is fully let or 90% let and has multi-year contracts still left. So we're going to see right now how investors are going to actually kind of be looking at, is an office space worth it, or do you think it's going to be oversubscribed? Now, I think something we saw in New York really interesting was the subletting of office spaces. So companies already have, let's say, a massive, in that office, let's say 20% of the office space, and now they've downgraded to 10% of the workforce there. What are they doing with like the other half of their area? They're subletting it. So will we see subletting increasing, and will that then impact other offices coming to market?
So, given all that, how does that figure into the CMBS market, and what are we seeing there on the structure side as well?
So the CMBS market obviously is tied in some form to the CRE market, and from the US, the CMBS market is kind of ticking along quite well as expected. It's a pretty well formed market, and there's already you've got your private and your agency going there. But compared to the European market, which is a lot less mature, we've only seen about 3 deals at the start of the year. So we saw Cassia 2022, that was the last mile logistics and big blocks. We've seen Beta Science, that's a pan-European office and science space, and we've also seen Pembroke 2. So that was a refinancing for Pembroke 1, and that was more towards an RMBS, about 151 loans backing it. Now, compared to the US market, we normally have a lot less loans backing our CMBS transactions. And then we also had one cancelled CMBS deal. So this was a student housing deal based in the UK, and it was spread across the whole of the UK. So really well diversified, had a lot of interest from investors, and even came out with kind of pre-market pricing from S&P and all the KBRA. So there's already investor demand, but it was pulled from market quite late in the deal process, and this was down to they couldn't price it. So there's a big issue right now with CMBS is it's designed to provide liquidity to the real estate market, but they still can't price it at a good enough rate for the investors in the ranges. And this then ties back into what we were mentioning earlier about how Finley said that a lot of investors are looking to move away from the UK student housing. So it's a prime example of a deal got quite far, but then fell through.
So, what needs to happen for some CMBS to happen in Europe?
It's a great question. If I can just jump in there, Andy. Yeah. So on our last podcast, we touched upon the Solvency II capital requirements changing. So Solvency II is a regulation that limits how much capital is going into different investments, and CMBS is something that CMBS was a market that was hit by that. So the UK government are currently reviewing that now that we are out of the European Union. So if that legislation does get amended to allow more capital to flow through, then that could open up and help drive European CMBS market activity.
No, I agree with Vivek there. I think if we can get more capital through and it can drive more activity, we'll be seeing more CMBS transactions. But there also probably is that investor sentiment of kind of hedging against it right now, saying, is it worth coming into the CMBS market? Okay, let's take it from a purely kind of maturity point of view. The EU market kind of picked up after 2013, you say, and so a lot of these loans are relatively new in this kind of sense of the global market, and they haven't seen a recession before. They've seen a pandemic slightly, but they haven't seen a full-on recession where interest rates have gone up. Everything's getting shocked a lot more. So we're going to have to see how will they actually develop, and that might be from an investor's point of view saying, is it worth staying out of the European market until we've seen it fully go through and see how it can handle, see if more defaults are going to be arising?
So, I mean, on the corporate CLO side, there hasn't been issuance though, right? Is that looking like a more robust asset class at the moment?
So yeah, I think CLOs have been a bit more optimistic on both sides of the pond now. I can't say in EMEA that it's been amazing and that's gone straight away what everyone expected. Obviously, at the start of the year, we came off 2021, which was one of the strongest years for CLOs. And we thought 2022 would see a lot of new issuance kind of coming into it. We knew that the resets and refis wouldn't be coming in there because after how many refis, resets there were in 2021, there just wasn't enough available deals. And then obviously the Ukraine crisis hit and issuance started declining over month and month. But there has been semi-solid issuance throughout it. So there's been 38 deals in Europe this year, and about 176 deals for the US. To put that into perspective, that's about 15 billion euros versus $75 billion. And just looking at a purely kind of number of deals difference, it's about 5 times difference for a market that's about 5 times bigger. So in perspective, it's going okay. What is kind of coming into now is a lot of the forward volume. So coming out, let's say JPM or Deutsche, they've kind of come forward and said, we're revising it down from about 150 billion for JP Morgan down to $110 billion for what the forward volume is for the rest of the year. So that's where they think it's going to be fully maxed and be hit out. So I think even though there has been solid issuance, the issuance coming into the rest of the year is looking to be declining.
I would just like to add there that Andy also leads our research team focused on producing CLO research. So if any of our listeners would like to understand a little bit more about what's going on in the European or US market and receive any of Andy's pieces, do reach out. And also our partner, the Yield Book, yesterday released a really interesting CLO market overview focusing on the US market, specifically looking at how manager performance has been and predicting how manager performance could be when markets are such. So if any of these topics that we've talked about today are of interest, please do reach out to podcast@trepp.com.
Yeah, I mean, I think at least when we've looked at it, it seems like there's been a lot of headwinds for CLO, both on the kind of the structure side and the fundamental side, right? Like there's headwinds around hedging costs in the US. At least there's actually uncertainty right now around risk capital rules for insurance companies because the NAIC has some rules out there that they're trying to change. And then on the fundamental side, obviously consumer-facing industries in particular have been challenging. But despite that, it seems like people are still optimistic. Like we said about the conference, there was still optimism that things would be okay. One source of the optimism was that Norton Shukin, one of actually the biggest buyer of CLOs probably in the world, certainly in Japan, has been kind of re-entering the market. Historically, they were extremely active in the US, and actually it sounds like they're also re-entering the market in Europe recently, which is really great news for everybody. And additionally, there's been some adaptations, I think, nothing wild, but there's been adaptations in terms of the structuring where, you know, they adjust how long the deal is or how much reinvestment can happen. So have you seen any of that in particular in Europe?
Yeah, definitely. So I think something that really helped within the first half of the SH1 of this year, and from a manager point of view, is how they were using shorter reinvestment periods or non-call tactics to kind of drive interest in the CLOs. So there has been an issue where we've heard at a lot of conferences around how do you kind of invest within the CLO tranches right now and how do you place them. So we've seen investors kind of favor the AA of the AAA. And recently, especially what I think is very interesting is we've seen a few deals come to market in Europe with the IC tranches being discounted. So Clonmore, which came out last week, has AAA tranche. The rest of the IC tranches were priced below par. And Jubilee, that's priced this week, had its AAA priced at 99.85. So we're seeing managers taking these new approaches to get more kind of investor-driven sentiment.
And is there, in terms of that sentiment, is there like an area that in CLOs or across structured finance in general where people are really focused? Are they moving up the cap stack because of the risks?
So, as I mentioned a second ago, I think from what we've heard at a lot of conferences is where the investors kind of looking at right now is at AA, as in Europe, about 4% now, 100 basis, and then in the US, about 600 basis return on it. From a volatility point of view, it actually provides better return against the AAA, but also gives you that protection against being downgraded. So something that's on horizon that everyone kind of knows about is downgrades will be happening. So we've heard a lot of investors are kind of looking at that AA, but they have also made arguments around the BBB. Even though it's at the top of the kind of investment grade, it needs to be then put down to sub. So it's kind of very dependent on where that investor kind of can see the risk adjusted returns coming in. But I would say firmly, I've heard the AA mostly kind of being thrown around.
Yeah, people want some safe stuff, but a little extra juice on top of it, right?
I think so.
All right, good. I think that's probably a good place to stop. So anything else you want to close out with? Any last words?
Absolutely. We had massive news earlier this week that the women's England football team won the European Championship, which is an incredible achievement. So huge shout out to all of them. I think that was it was an incredible match and a great 2 goals by the team. So really looking forward to the World Cup in December now.
I can't say much about that win made its way over to the US news, but I think I saw a little bit about it. Who are you predicting for a World Cup?
For the World Cup win, of course, I'm going to say England, but the men's team have always let us down in the past, well, especially in my lifetime. So I'm a little bit hopeful that they'll make Christmas time that little bit more special during the World Cup in Qatar.
Well, with that, we'll close. Thanks to our producer, Haley Keene. Join the team later this week for our regularly scheduled weekend review as we look at what's happened during the week and how it may be impacting you. If you have questions or comments, please send an email to podcast@trepp.com and subscribe to the podcast with your favorite provider. Thank you for listening and stay well. All right.